Thanks for tuning into the Portfolio Manager. It's a show where we try and peek into the minds of the portfolio manager to figure out how she or he is positioning the portfolio for creating alpha over the course of the next 12 to 24 months or longer. Our guest today is Naveen Chandramohan, founder and fund manager at ITUS Capital. Naveen, great having you. Thanks for taking the time out.
Good afternoon, Niraj, and good afternoon to everyone on this show. Thank you so much for having me here.
The pleasure is entirely ours. Now, I'd love to understand, how are you thinking about the portfolio construct currently? Is it more defensive than aggressive in nature because of the valuations, or do you believe being aggressive might still pay out?
So I think if you allow me, Niraj, I would like to tune out a bit before I then go into the question. I think I've always believed in the value of cycles, and that comes again from studying history a lot. So I think the cycle that we are in is what I call a GDP beneficiary cycle. It's quite contrary to what we saw in terms of global markets as well as Indian markets between 2010 and 2020. So effectively between 10 and 20, you didn't see GDP expand, not just in India, but globally. And post-COVID, post the inflationary regime that we are in, which I think we will continue into over the course of the next 3 to 4 years, I do believe that GDP-facing sectors should show better growth. So within that broad framework, I would want to position portfolios towards those areas. So if you look at the portfolio from a top-down perspective, we would be overweight cap goods, we would be overweight power, energy, auto and auto ancillaries. We have been underweight banking, and we have been underweight consumer. We don't have any IT exposure, and effectively that is how our portfolios are constructed.
Sorry, IT services, 5%?
So IT services, the only company that we have is an ER&D services company.
Okay.
So it's not the typical services-based company. It's more so engineering R&D services-based company that we own there.
Okay, and I'll come to that. But first, it still doesn't answer my question, Naveen, about whether the portfolio is aggressive or is it defensive. Even in power or even in auto ancillaries, you can take aggressive bets or you can take defensive bets by virtue of the nature of the businesses that you're betting on. So is your portfolio aggressive or is it defensive in nature?
So again, I don't know how we qualify aggressive and defensive. So for me, a portfolio construct where liquidity is taken into effect and earnings growth is roughly between 18 to 20% is what I would look for.
Yeah, but even if it's coming at a higher valuation?
So the valuation, if you look at a trailing PE perspective of our portfolio, it's roughly 12-month TTM is around 27.5. So in order to get an 18 to 20% earnings growth, you have to pay up a bit. You're not going to be able to buy at today's valuations a TTM of 10 to 12 PE. That doesn't exist. So the question is, how much are you willing to pay up? You can go into the consumption space where you have to pay up a lot more to own these businesses. We are not willing to do that. You can go into cap goods. You can go into power, where I still think the valuations are reasonable. So we don't think about it in the traditional sense of saying IT and pharma are conservative and the rest of the businesses are aggressive. To me, equity is aggressive. So the question is, equity means volatility. My job as a fund manager is to reduce that volatility. If I can do that consistently across time, returns are an outcome. So we still own pharma. We still have an overweight in pharma. Does that mean that's a conservative bet? I don't think so. That's not a defensive to me. That still is aggressive.
Yes, most certainly is. Okay, so viewers, the market cap orientation of ITUS Capital, large caps 47.5, mid cap about 19.2, and small caps about 13% as of the last data that has come in. Now, Naveen, would love to understand some of the bets that you've taken, and we'll get into the more obvious ones in the second half of the show. Right now, I'm trying to talk about the ones where you are either large overweight or an underweight relative to the street, right? Auto ancillary intrigued me simply because while people have been constructive on autos, and you are constructive on auto as well with 7% weightage, but 9.7% weightage on auto ancillary shows that you are really constructive out there. Now, give us your thought process here.
So end of the day, again, auto has and will continue to be an extremely cyclical sector, right? Now, if you go back 10 years in the past, and when you study auto ancillaries, you have very few scaled up businesses in auto ancillaries. Auto ancillaries don't lend themselves into pricing power at all. So they always have been a cost plus business. Margins are, if you can get to a 10% EBITDA margin, that's like a dream come true because you get squeezed day in and day out. Now, with manufacturing moving here, there are a lot of technopreneurs who have been in this business for the last 35 years. They either have been playing on the back of import substitution, or they have a unique niche R&D that they have established, which has lent itself into what you call deemed exports. These two put together tend to have characteristics of giving you a high teens EBITDA margin with a sensible debt profile. If you can get these, that's the space I would be overweight. So I'm not saying we own businesses across the board. It's a technopreneur that we are backing. It is R&D ability. There is a lot of import substitution, so you have the ability to expand your margins. Your today's ROEs would roughly look at 16 to 17%. Many of them have actually put up Capex on the back of import substitution orders, which means they can expand from 16 to 17 to closer to 20 to 21. And that's the space that we are backing.
Okay. So again, just to clarify so that our viewers understand, auto ancillary is a very wide bucket.
Correct.
Forging companies, wiring harnesses, tires, what have you, right? And now the EV thing as well. What have you chosen within this this auto ancillary space? What kind of themes? I don't know if I'm at liberty to name companies, but whatever, whichever way you can help our viewers understand why is it that you're betting and what are the kind of auto ancillaries that you're betting on?
So for example, if you go back in time, let's say 7 years back, and take an M&M, right? When most of their powertrains that they manufactured would actually stay in-house because the machining requirements of a typical ICE engine, the powertrain that you manufacture, mostly are commoditized. So end of the day, for you to scale, there was no powertrain manufacturer in India who was generating more than 1,500 crores of top line 7 years back. Today, you actually have companies doing north of 5,000 crores in top line, doing powertrain both for the deemed exports as well as you're transitioning into an EV, you cannot have the same machining requirements. The machining requirements in terms of precision, the torque transfer requirements are going to be a lot higher. So you have niche components in the south that we are backing, that we are heavily overweight on. When I say heavily overweight, for us, 3% in a particular company would be overweight, considering, as you rightly pointed out, auto ancillaries, by their very definition in India, are low, mid to small caps by nature. The largest auto anc company in India is a market cap worth 24,000 crores, right? So historically, auto ancillaries haven't lent themselves to scale. And as auto exposures go up in terms of market caps going up, you will see certain auto ancs with an R&D component behind it expand too. Those are the companies that we would want to pick. So it's purely bottom up, it's purely balance sheet driven, and that's what we would back. It's a mix of both four-wheeler and two-wheeler as well.
Okay, so you're shying away from calling, let's say for example, for argument's sake, a Samvardhana Motherson with 80,000 crores market cap as an auto anc, or a Bharat Forge as an auto anc per se.
I wouldn't call a Bharat Forge certainly as an auto anc. They have a much wider portfolio. And a lot of what they do is an EBITDA margin of what they do is a machining plus precision. So that's not the space that I'm looking at. Though they should do well as well.
Yeah. Okay, fine. Get the drift. And you have a 7% addition in autos as well. That is stayed. So you're constructive in autos. Is it four-wheelers? Is it two-wheelers? You clearly have Maruti as one of the overweights out there. So you are bullish on four-wheelers that I can see. Are you constructive on two-wheelers as well?
I think if you look at the last 10-year volume growth of two-wheelers, it's been 3.2%. For a country that has actually relied on saying that two-wheeler volume is the go-to market, the actual data points tell you completely otherwise, right? So today, for the first time in the last 3 quarters, you're seeing two-wheeler growth after a 10-year period. So the question then becomes, where did, let's say, a Bajaj Auto or a TVS Motors growth come from in the last 5 years? It came from two aspects. It came from exports. And it came from pricing power. So many of these companies who actually upped the model CC in terms of where they went up the value chain, that's how their revenue growth came from. Today, for the first time, after a period of 10 years, you're seeing volume growth come through. And I think that could last over the next cycle. When I say cycle, I'm not talking more than 3 years as we speak. So I think two-wheelers can surprise on the volume side. That's a space that we would want to own. And four-wheelers, we continue to be bullish on.
Yeah, but and you're right. Cycles too have gotten compressed in a big way, right? I mean, these days, cycles by themselves are very different from what cycles probably used to be, economic or otherwise. Just as an extension, you mentioned ER&D. You are so constructive on autos. Is the ER&D presence an auto-specific presence or not necessarily so?
Auto is one of the components. So engineering R&D will lend itself into Capex-driven businesses. It could be oil and gas. It could be aerospace, auto, telecom. So all of these sectors, if you look at it, didn't have great volume growth between 10 and 20. All of these sectors basically had degrowth. And as the Capex cycle revives, and it's one of the things that I keep saying, I think we are in an inflationary cycle. We are not in a rate cut cycle. Maybe you will see, because of political pressures, 1, maybe 2 rate cuts. 2 is already an overextension as far as I'm concerned. But I think we are in an inflationary cycle and not a deflationary cycle. So end of the day, I think in an inflationary cycle, GDP-facing sectors should do better. You look at what happened in the US between the 70s and 80s. I don't want to use the India example between 03 and 09 because the base effect as well as the growth that you saw was extremely non-linear. And I'm not sure you're going to get that level of growth in this cycle. But I think US between the 70s and 80s is a better example of an inflationary driven growth. So metals, oil, energy, these are the sectors that should do well.
Which means, Naveen, I'm taking that conversation forward, that you are not seeing green shoots in IT. I've been questioning now for a while what is it that people see there, but Accenture's numbers finally show that amongst the largest companies is not talking about any turn in demand. But is this the time to buy IT, or would you wait for some evidence and say that it's okay to buy it 5-10% higher, but at least let the tide turn?
So Niraj, I think rather than get into the price, for me the question is, am I seeing visibility of growth? And I don't see that yet. Today, the reason margins look accretive is because many of them have managed their employee costs much better. For me, as a core business, what I want to see is top-line growth, translating into operating leverage and hence margin profile. And you not just running efficiency in terms of your cost base well and getting an EBITDA margin expansion. So broadly for me, I would put my hand up and say I would rather stay underweight because I don't see any green shoots of growth. If growth does surprise to the upside, I'm happy to relook at it. But for this growth, I don't think the valuations are cheap.
Okay. There is, amongst the largest allocations that you have is auto ancillary, capital goods. But when I look at your top 10 holdings, I don't see auto ancillaries there. I don't see capital goods unless you classify the ports company as a part of that. But it's infrastructure and not
Correct.
ports. So you obviously have spread out your capital good bets across multiple companies in small measures.
Absolutely correct.
Where is the largest conviction within cap goods then?
So cap goods with a power angle is where the conviction is. So a lot of capital goods which actually manufacture for the power sector and the energy sector, that's where the higher conviction is. Because today, capital goods don't come cheap. And
yes.
Your non-linearity has come in between 21 and 24 in terms of growth. So the growth from here is going to come on a higher base. So I would pencil in a 15 to 18% growth from here, which is not trivial growth either. But the valuations that which you're paying up for that growth is not cheap. So I would want to build in starting exposures today with the ability for me to size up higher over time if I can get more volatility.
So the likes of power cables, etc., come into play, or what's the exposure within cap goods?
I mean, in terms of large caps, for example, we own an ABB, we own Cummins, we own Thermax.
You're not shying away from high valuations, I see.
Again, so we use this word very loosely in our conversations, Niraj, because let's take ABB for an example, right? And again, I'm not saying someone needs to be buying ABB today. It's not a recommendation at all.
Yes.
But you go back to 21. ABB was available at a TTM of what from a PE perspective? Assuming PE is the easiest metric for someone to relate to, was at 65, right? So was that cheap for a company which actually had 3-year growth of 11%? Or are you going to say that when I'm getting a 23% CAGR in growth with a future growth potential of 15 to 18%, a 75 PE multiple is something that I'm okay to pay up? So my question is not starting off by saying what is cheap. My question is starting off by saying where am I seeing growth and where am I seeing sustainability of growth? And for that, what is the valuation I'm paying? I'm not saying these valuations are cheap, but then the question is how do I position size this in order to ensure if I'm going to pay up at an overall portfolio level, my portfolio construct doesn't get affected. So it's not one name that's going to drive my returns. It's basically saying for this valuation, for the visibility of growth that I'm seeing, do I want to be staying out of this sector? Answer is no, because that's where I see visibility of growth.
Nice. And in some sense, viewers, a good way to follow this might also be comparing the past valuations or historical valuation cycles as well, because a lot of times some stocks tend to trade expensive. For the longest time, people question why is Growth Finance trading at the valuations that it is, and at some point of time it will correct, and it never did. That is not to say that the likes of ABBs won't, maybe they might. And remember, Naveen mentioned that none of the things that we are recommending or speaking about here are recommendations. They are illustrative examples, so please keep that in mind. I mean, there's just that disclosure from our end as well. The other aspect is power. Now, tall targets, a lot of scope, but a lot of people cite past execution misses and execution risks not being factored in. What is your sense around this?
So, let me play both sides of the coin, Niraj, right? I'm going to make a fairly tall claim by saying that you are going to see over the next cycle maximum number of solar bankruptcies that you've ever seen. Because the cost at which and the IRR at which some of these projects are getting bid up and some of the smaller companies are setting up solar capacity doesn't make any sense on the ground, right? So end of the day, obviously there is going to be enough and more supply that comes in because demand for the first time after a period of 12 years is growing at a CAGR of 9%. End of the day, power in terms of supply side will and should grow at the cost of GDP. Now, basically over 2010 to 2020, when you kept setting up supply and GDP was at 3.5% over a good part of the decade, you had excess capacity. And hence, a lot of the companies went into significant debt on their balance sheet, and you saw a huge amount of value erosion over the last 12 years. For the first time, you are in a power deficit cycle. And that deficit basically meant because you have not invested for a good part of 10 years in an aggressive way because demand didn't come, for you to set up a greenfield in thermal does take 4 years. Whereas if you go into solar, it takes 12, 14 months. So it's a lot easier to set up solar capacity than it is to set up a thermal capacity. So, and one of the reasons that India is in a much, much better position is we didn't take this ESG tall-headed claim of saying that we will not burn coal, because coal is extremely essential. And today, many of the countries in Europe are realizing that. They did that, and now they've gotten killed on the other side. So if I am going to bet on power, which we are, I would much rather bet on a large portfolio which has a good mix of thermal on one side and an element of renewables on the other side. Because renewables, it's good, they will see growth, but at the same time, I am not really as bullish on renewables where the IRRs will be close to mid-teens on a sustainable basis, because these are all what you call plugging the gap. Wind energy is not going to be self-sustaining. Solar energy can be, but the kind of bidding that is happening on the ground is not very comforting. So I would still back a thermal-led portfolio into renewables rather than a renewable-led portfolio into thermals.
But effectively, then you're telling me about the power generation companies.
Yes.
It's a wider bucket out there below that too, power financiers, power ancillaries, so on and so forth. Anything in that bucket, or is it only generation?
I mean, I think we don't own power financiers. Today we find them a bit expensive. They still can do very well, right? But that's not the space that we are looking at from a lending perspective. Power generators is one space we are bullish on, and hence that will translate into a power transmission also. Because end of the day, in order for power to get into the grid, the transmission capacity has to go up in a significant way. So I think transmission and generation is going to benefit as a result of this. Financials could, we don't own them, so I don't have a very strong view. Easy thing to say is valuations are expensive, but I don't think that's a prudent statement to make.
Last question. You have an outsized position in pharma relative to markets again. One of your top holdings is not a traditional pharma firm, but a pharma company, CRO, CDMO, what have you. What bucket of pharmaceuticals are you most constructive on?
I think today, many fund managers have dissected pharma in a beautiful way, right? So I'm not going to break it down. Indian pharma is pretty much works like an FMCG business. It's a branded business. Everyone would want to own that. No one wants to own US generics for all the right reasons, because it's a commodity play. You don't have pricing power. But I also feel that cycle, in terms of the rate of change of price erosion, is reduced. You still don't have price increase, and I don't think that's coming back anytime soon. So in terms of what we like in pharma, we like product portfolios with an Indian-facing angle, as well as CDMO manufacturing. That's a space that we think has significant tailwinds. You're seeing businesses which have no background in CDMO acquiring, deploying capital and getting involved. Capital misallocation does happen at a time where capital is abundant, and free cash flow of many of these quality corporates is abundant. So you're going to see a lot of capital allocation into those spaces. So the company that we want to be owning are those that have 10, 15, 20, 25 years of track record in manufacturing. They've done this. They have sticky B2B businesses. We also do have businesses which have a US generic component as well, because that cycle has not played out, could play out in the next 2-3 years. It has played out from a margin expansion perspective in the last year, and I think in the next 6 to 8 quarters, you could see more runway for that. So broadly, we have a mix of CDMO manufacturing, Indian branded play, as well as a US portfolio as well.
Great. Naveen, on that note, thanks so much for taking the time out and being with us, and for coming to our studios. Really appreciate you taking the time out.
Thanks a lot. Appreciate this, Niraj.
Yeah. And viewers, thanks for tuning into this edition of The Portfolio Manager.